Open 19 to work together. Brookdale Banners bought the following assets during year one. Brookdale uses the straight line depreciation method. You're going to calculate beginning book value, annual depreciation, accumulated depreciation, and ending book value for each asset for each year of estimated useful life. If the asset was not bought at the beginning of year one, you need to calculate the depreciation expense for the part of year one in which the company owned the asset. So on January 4th, we bought a display case costing $4,040. Estimated salvage value is $200. Estimated useful life is 8 years. So they've already started our plant asset record sheet here. So display case is already filled in. Depreciation, we are using straight line. The original cost was $4,040. We get that from the directions. Same with the estimated salvage, which was $200. And then useful life is 8 years. Says what we bought it on January 4th. Okay, so now what we need to do is we need to fill out each one for each year. So beginning book value of the asset is simply going to be the original price, so $4,040. Now we have to figure out what the annual depreciation is. So annual depreciation is when we are going to take $4,040 minus the salvage value of $200. We're going to take that number then and divide it by the useful life of 8 years. And we see that our annual depreciation is going to be $480. Now, we bought it at the beginning of January, so we owned it for a full year. So that first year we are going to depreciate for the full amount, $480. The accumulated depreciation is simply $480 again. And then the ending book value is where we're going to take the beginning book value minus the accumulated depreciation. So now we have 3,560. This number here is simply going to be moved to the next line as our beginning book value, so 3,560. Our annual depreciation is going to stay the same, so $480. Our accumulated, however, is going to change. We're going to take the previous year's accumulated, so $480, plus this year's annual, another $480. So $480 plus $480 will be $960. Now to figure out our ending book value, there are two ways that we can actually figure it out. We can take the original cost of the asset, which would be $4,040, minus the accumulated depreciation, which was $960. So that will give us $3,080. The other way that we can take it is the beginning book value of that year, $3,560, minus the depreciation of that year, $480. Okay, so both ways should give us the same number. Again, the ending book value becomes the next year's beginning book value. Depreciation stays the same for the annual. We now take the previous year's depreciation plus this year's depreciation. So $960 plus $480. Ending book value, we either take the original cost minus the accumulated, or this year's beginning book value minus annual. Okay, that same number then becomes our beginning book value for the next year. Annual depreciation stays the same. Accumulated, we're going to take $1,440 plus $480. Figure out our ending book value. That number is also our beginning book value of the next year. Annual depreciation stays the same. Previous year's depreciation plus this year's depreciation. Figure out our ending book value. Bring that number to our beginning book value. Same depreciation. Add that year's depreciation to the accumulated from last year. Find our ending book value of year 6. Ending book value of year 6 becomes beginning book value of year 7. Depreciation stays the same. Figure out our new accumulated depreciation. Figure out our year 7 ending book value. Carry that number to our year 8 beginning book value. Same depreciation. Our new accumulated depreciation. And then our ending book value. Notice our ending book value also equals our estimated salvage value. Okay, let's move on to our next one. It says on September 20th, we bought a workstation for $4,800. The estimated salvage value is $0 and the estimated useful life is 5 years. So let's go ahead and fill in the top part first. Again, we're going to be using straight line depreciation. The original cost, what we paid for it was $4,800. We're estimating it will be worth nothing when we're done with it. We're going to estimate that we will use it for 5 years. And we bought it on September 20th. Okay, so the first year we're going to fill in our beginning book value, which is the original cost, $4,800. And now we need to figure out the annual depreciation for that first year. So again, to figure out depreciation, we're going to take $4,800, the original cost, minus the salvage value, which is 0, and that just gives us the $4,800. Now we're assuming we're going to use it for 5 years, so divide that by 5. That gives us $960 a year. However, on this one, we need to be careful because we did not buy it until the end of September. So we do not want to depreciate that first year for the full year when we didn't own it for the full year. So now we have to figure out how many months we owned that asset. Now we bought it on September 20th. So do you remember what the cutoff date is? Remember the cutoff date is the 15th. So in this case, we're not going to count September because we bought it so late in September. So if we count, we're going to count October, November, December. So that is 3 months of owning that asset. Now we figured out that $960 was the annual depreciation. So now we have to figure out the monthly depreciation. So 960 divided by 12 means that that asset depreciates $80 a month. Now we figured out that we owned it for 3 months. So we're going to multiply 80 times 3 to get that year's annual depreciation of $240. Okay, our annual or accumulated depreciation then is simply $240. And our ending book value is $45.60. Okay, again, that becomes our new beginning book value. Now this one for year 2, now we're going to own that asset for the full year. So now that depreciation is going to be the full $960. Okay, we're going to add $240 plus $960 to get our new accumulated. Find out our new ending book value. That becomes our year 3 beginning book value. Annual depreciation again is $960. Figure out our new accumulated. Figure out our new ending book value. That becomes our beginning book value. Same depreciation. Figure out our new accumulated depreciation. Figure out our new ending book value. Same depreciation. Okay, again, we have to be careful on this one. We cannot just put the annual depreciation in again. When we look at the beginning book value of that workstation is $720. If we put in that annual depreciation of $960, we would end up with an ending book value of a negative number, and that can't happen. Remember, our estimated salvage value is $0. Okay, so we have to figure out what would get us to that ending book value of 0. I'm just going to go ahead and put that 0 right in there. Okay, so if we took that 720 minus 0, that simply means that our $720 is what it will depreciate that year. The other way that we can figure that out is, remember, we bought it in late September. We only counted that first year. We only counted October, November, and December. Now, we're depreciating for 5 years. So depreciate for a full 5 years, we would have to look at then January through September. So January, February, March, April, May, June, July, August, September. That is 9 months of owning that workstation. Remember, we figured out that it was $80 depreciation a month times 9. That would also give us this number of $720. Okay. So now I'm going to figure out my new accumulated depreciation. And I already figured out my ending book value. So that is good. Check my answer. And save and continue. You can now complete the 19.2 on your own. When you are done with that, please go to 19.3 lecture.